Hi there everybody and welcome back to another stock analysis video. Today we are going to be doing a company that I actually like a lot, and that is Qualcomm. They are a semiconductor company and y'all know how the semiconductor industry is right now. So I want to see how this company's stock price actually matches with its fundamentals. So with that said, let's get started with this analysis. Starting off, guys, this company pays a really juicy dividend at 1.65%, which ends up being around 68 cents a share. And this is actually the main reason why a lot of people like this company. At least this is the reason why I like this company. Annual payout is around $2.72 per share. Payout ratio in regards to their net income is about 28.02%. The 5-year growth on this dividend is around 5.61%. They have grown this dividend for 11 consecutive years, so a little bit more than a decade, which is really good. Chances of them continuing this is very high. Ex-dividend date's actually coming up on March 1st, and they actually pay out this dividend on March 23rd, so the same month that the ex-dividend date is announced, and they pay their dividends quarterly. Now coming over here to the calculator, we got the ticker symbol QCOM, QCOM, market cap of $185.5 billion, PE guys of 18.87, which is looking like it's a good buy right now. However, this is only one metric. We want to see the others and then make assumptions as to where this company is heading in the future to then bring that to today, come up with a market cap, and then figure out what we should be paying today based on what we think the shares outstanding are going to be in the future. Current share price, guys, is $164.64. Now, recently, within the past 5 days, this company has actually gone a significant ways down, all the way from $184 on February 9th, all the way to now, as we just saw, $164.59. So even with this drop, we're going to see if this is now the correct amount that we should be paying, or should we wait for this to fall a little bit more. As we saw, they do pay a dividend around $2.72 per share, which actually ends up being around $3.1 billion being paid out in dividends every single year. And comparing this to the free cash flow, the 5-year average free cash flow, they still are left with around $2.3 billion left, which actually comes out being a payout ratio in regards to the free cash flow of 56.9%. Now this payout ratio is actually very close to my 60% marker, but we are still barely under that. So for all intents and purposes, at least for me, they are able to afford this dividend for starters, and two, they are within my threshold as to where a company should be in regards to the free cash flow to be paying out this dividend. Now coming over here to the fundamentals, we got the net income 5 years ago of $2.4 billion to 1 year ago of $9 billion, which is an increase, guys, of 270%. The big outlier here is the fact that 4 years ago they did negative $5 billion in their net income, which is very concerning. However, this is one of those things that I suggest for you to do more research as to why they did negative income 4 years ago. So does this mean that for me, does this mean that you automatically don't buy? I don't necessarily think so, because just because they had negative income 1 year doesn't necessarily mean that this is the case every single year. Something may have happened or anything like that. I don't necessarily know. But for all intents and purposes, do your own research on as to why this happened. Me personally, I do not believe that this will continue to happen anywhere within the next 4 to 5 years. Next, we got the free cash flow, the lifeblood of the company. It is the cash operations minus your capital expenditures. 5 years ago of $4 billion to 1 year ago of $8.6 billion, which is an increase of 101%, with an average 5-year free cash flow of $5.4 billion. Now, unlike the net income, we actually don't see any negatives here on the 4-year ago mark. Now, obviously, 4 years ago and 2 years ago, they did slightly go down in their free cash flow. However, the trend line is continuing to go up, and I foresee that even with this chip shortages, as prices go up with chips because they are in high demand and low supply, I have a feeling that the free cash flow will continue to be going up. Next, we got the revenue 5 years ago of $22.3 billion to 1 year ago of $33.6 billion, which is an increase around 50.8%, and pretty steady from the 5-year ago mark to the 2-year ago mark. However, 1 year ago, they just completely exploded all the way up to $33.6 billion. Next, we got the total assets minus the total liabilities. This one pretty much just tells you whether or not they are able to afford their debt. And obviously, the higher that the total assets go up, that means the higher the total assets are, that means that they're able to afford it more. Now, currently, guys, they have around $8 billion in total assets minus total liabilities. So they're still able to cover this. However, the one concerning issue is that 5 years ago, they had $32.7 billion, and right now it has gone all the way down to 8. So that is really, really bad to see, the fact that they have actually been either decreasing their assets or increasing their liabilities. One of these two has to be correct. And even though they're still able to afford it, the fact that it is going down, it is a little bit of an issue for me. Taking the total average total assets, we get around $22.8 billion. Taking the total average liabilities, we get around $10.7 billion. And doing the average assets minus the average liabilities, we get around $12.1 billion. Next, guys, taking a look at the shares outstanding. The silent killer when it comes to investing. This tells you whether or not the company is diluting you as the investor. And well, 5 years ago, they had 1.5 billion shares to today of 1.1 billion shares, which is a decrease on the 5 year of almost 24% at 23.68%. The previous year to the current year, they have decreased to around 0.5%. So really, really good that they are buying back shares at a 23.68% rate, which is really, really good. In fact, they had a massive drop 5 years ago to 4 years ago, which is really, really good to see. They're buying back shares and they're increasing your ownership in the company if you hold these shares. And last, we got the cash equivalent, and currently they have around $6.6 billion in cash equivalents with an average cash equivalence of $13.2 billion. Now let's come over here, guys, and make some assumptions. I'm going to make a low, median, and high assumption, and I'm going to assume the growth, projected share buyback, and I'm going to keep the required rate of return the same at around 10% to match the S&P 500. Now, the growths, as you can see, for all of them are pretty high. And my reasoning for this is that looking over here at CK Alpha, we got the revenue growth year over year at 35.02%, and the revenue growth forward, so this is analyst estimates, is around 28%. So for my low assumption, I'm going to assume a growth of around 25%, and the predicted share buyback, I'm going to say 3%. Now, the reason why we're seeing that huge massive share buyback at around 27% is because the fact that from 5 years ago to 4 years ago, they dropped a huge amount. Will they be able to do this again? I don't think so. I think 3% is a pretty good assumption for them buying shares back at the low assumption. And in doing so, we get a target share price, not adjusting for that, of $91.50. For the median assumption, I'm going to assume a growth of 27%, projected share buyback of 5%, and this comes all the way up to $103.36. And for the high assumption, I'm going to assume a growth of 30%, predicted share buyback of 7%, and this comes out to be a target share price of $120.26. Now adjusting for debt, this number actually comes all the way down. The way that we adjust for debt is we take the total cash that they have on hand and then subtract the net debt and then add that to the market cap. In doing so, if a company has more debt than cash on hand, then obviously this number comes down. So for the low assumption, we get a target share price adjusting for debt of $87.18. For the median assumption, we get $98.76, and for the high assumption, we get $115.35. Now adding a margin of safety of 5, 10, and 15%. For the low assumption, we would like to buy at $74 all the way up to $82. For the median assumption, we would like to buy between $84 and $94. And for the high assumption, between $98 and $109 will be a good buy. Now guys, the current share price is $164. So if you believe that my assumptions are correct, if you believe my growth, if you believe my predicted share buyback, then we would have to wait all the way for the highest assumption. We have to wait all the way for this thing to drop all the way up to $115 to adjust for debt, and even $120, and even $120 not adjusting for debt. But then again, guys, these are just my assumptions. If you do not agree with them, then I highly suggest you get this calculator. I have it for free on my discounted free cash flow calculator video. All I'm asking for is like, subscribe, comment, and share, and also hit the bell. I try to upload pretty much every single day, and I just want to grow my channel. I'm giving this calculator out for free. All I'm asking for is please help support the channel. That's really all I'm asking for. All in all, guys, QCOM semiconductor company, I think that semiconductors are not going to go away anytime soon. We are heading towards an era of more technological advances. We're going to need way more semiconductors. So I don't believe that QCOM is going to go away anytime soon. But then again, guys, they do have a lot of competition, right? You have other chip companies, you have graphics companies, and all this stuff. So I don't necessarily know where you will put these guys at, right? But nonetheless, I think that they are a very good company. They do pay a very good dividend that they are able to afford. The issue again here is that, like every other tech company that we have analyzed, is that they're way too expensive right now. It needs to fall down a significant amount, or their fundamentals need to go up. But that's pretty much my 2 cents on this company. I like it. I just wish that the price were to go down a little bit more. But that pretty much does it for this episode. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble. When I listen to my stock analysis videos and crypto videos, you will find exclusives as well. And when it comes to Rumble and YouTube, I have a Let's Play channel where I'm currently playing through Pokemon Legends Arceus. So if you want to catch that, then you can find the link in the description below. So with that said, peace out and be on the lookout for the next stock analysis video.